Good morning, everyone. Thank you for joining us for our program today. What is going on and at LIBOR Y2K? What is going on and what does it mean for me? My name is Larry Parker and I'm the chair of the firm's mergers and acquisitions team. And today I'm joined by my colleague, Matt Cheek. Matt is the chair of our financial services and real estate section, and we're both based in Richmond. Before we start off the program, Matt, go ahead and forward to the third slide, please.
There we are.
Yeah, we have a few housekeeping matters. The Q&As. If you have a question, please put it through the Q&A button. We will answer them at the end of the presentation, time permitting. But if not, we'll be in touch after the presentation's over. If you have any technical problems, please use the Q&A button, and our marketing team will help you resolve those as well. Of course, you'll receive a copy of the presentation materials and a link to a recording of the program later today via email. So, Matt, how is the change from the LIBOR benchmark rate to SOFR relevant to not just corporate finance professionals, but also M&A practitioners?
Well, Larry, I'm glad you've asked. So I'm Matt Cheek. It's great to be with you all today to talk about a subject that I find absolutely fascinating. Other people might find a little bit nerdy, but first of all, I'm not an economist. I'm not an accountant. I'm a finance lawyer who's been around the hoop watching this movie play, and it's been absolutely fascinating. The executive summary of today's discussion is this. From 2016 through 2019-ish, this cessation or death of LIBOR was a super hot topic that people running around with their heads cut off, Chicken Little, the sky's going to fall, it's going to be Armageddon. And then COVID hit. And this entire LIBOR cessation issue just kind of melted away and was eclipsed by COVID. And we sort of forgot about it temporarily. Now the game is back on, but for reasons that you'll understand by the end of this quick conversation. In effect, I'm calling this the Y2K issue because for those of you who are around in New Year's 2020, you remember watching to see the ball drop in Australia and watch some sort of pandemonium occur at the first point in time when Y2K switched. And of course, nothing happened. And this whole LIBOR cessation issue has been occurring and will continue to occur almost like as it will happen with a whimper, not so much a bang. That's your high level summary. That's what you're going to take away from this today. But now here's the guts of it, because the guts of it are actually a pretty fascinating passion play that's been going on during COVID. Why is this relevant to me? Well, we all know what loans are. We know what interest rates are. We're familiar with fixed rates, of course, per annum. And then we're familiar with floating rates like a base rate of prime plus some sort of spread, or here LIBOR plus some sort of spread. We're familiar with that, right? Where does this pop up? Well, certainly you would see LIBOR in loans from banks. You might see it in loans from companies to other companies. You might see it in intercompany debt between affiliates. And indeed, you might see LIBOR pop up in long-term leases, contracts, and things of that nature, Larry.
Right. I've got plenty of operating agreements out there that have a floating rate interest for capital contribution default. LIBOR used to be the benchmark we used, and the last 2 years I've been using Wall Street Journal Prime because I didn't know I didn't have another good option. But
right, and it's funny you mentioned operating agreements because as well, subordinated shareholder debt too, or shareholder debt of any type is another place you might see it pop up. Okay, so these are the contexts where you might see in spot LIBOR, but also, do you deal with money? Are you in finance? Do you walk around town going to cocktail parties and want to appear knowledgeable? And I don't know if this is impressive to your spouse. This is my favorite slide of this whole thing. This is the godfather of LIBOR. His name is Minos Zambanakis. And I think if you compare him to the Dos Equis coolest man on earth, I think he rivals him. And indeed, if you know his background, you might agree. He was the second of 7 kids, grew up on a dirt floor in Greece. He's known as the Greek. Literally no electricity, no running water. In 1943, he was smuggled in the bottom of a smuggler's boat out of Nazi-occupied Crete. He eventually studied at University of Athens. He studied at Harvard, as a matter of fact, ended up as a financier in London. And when the Shah of Iran in 1969 needed $80 million of a loan, which back then was a pretty enormous loan, and the Shah of Iran wanted it based on a stable international rate, Minos Zambanakis, the godfather, came up with LIBOR. And the way he came up with it was to take a number of financial institutions and have them self-report to one another what they would lend to each other overnight in an unsecured fashion to each other, based on each other's creditworthiness. And then they averaged that number and came up with LIBOR. And hence LIBOR was born. Over the next 45 plus years, LIBOR grew and grew and grew in popularity. Why? Well, LIBOR is not tied to a country. The number of reporting institutions were indeed international. LIBOR stands for the London Interbank Offering Rate, but it was tied together and tethered to a lot of international institutions. So it's international. It's not tied to a country. Countries are volatile, so it's not tied to something like U.S. Treasuries. Additionally, it's not primed. Prime is sort of a retail rate that's a bit speculative. So it had stability. It grew so much that not only large institutions, but frankly, community banks, regional banks have been using LIBOR for decades, to such a degree that at its prime, the amount of loans in the country that were based on the LIBOR rate reached $200 trillion. That's trillion with the T in loans. But remember, folks, the rate itself was designed on a hypothetical interest rate if we were to lend to one another overnight. It's not what we are actually lending to one another overnight. It's what we would. It's a hypothetical. Okay, so hold that thought. Why is Minos's baby going to be killed? And the answer is manipulation. Humans ruined everything. In 2012, regulators determined that 12 banks had colluded to manipulate LIBOR. This included a lot of large banks that are household names like Citi, Barclays, UBS. They were fined a princely sum of $9 billion as a result. But the other interesting thing that I find economically the most interesting part is this concept of an elephant dancing on a walnut. I mentioned that there were $200 trillion in loans based on this hypothetical rate, but how much was actually trading? And the answer was very, very, very little, less than $1 trillion. It was hovering around 500 billion. So you have $200 trillion in the marketplace based on a rate that is not actually actively being used. That's the elephant dancing on a walnut. And then why is it also going away? Well, because of its market manipulation and its unreliability, it's almost a self-fulfilling prophecy that if we don't trust the rate, then it becomes unreliable sooner. So all of those factors led to an international movement to kill it. All right, before COVID, this was the plan. Before COVID, it was going to be killed 12/31 of 21. And when I say killed, I mean, technically speaking, the Financial Conduct Authority, which is the source where all of the banks would report in, didn't need to compel self-reporting after that date. That was the original plan, okay? After COVID, all the goalposts got moved. So basically, they shifted that date to June 30th of this year, okay? But in the meantime, regulators told U.S. banks that they had to discontinue LIBOR originations for new loans at that same date of 12/31 of 21. So if you've noticed, there haven't been any more LIBOR-based loans since New Year's 2021. The other thing that I didn't mention here is that really U.S. regulators are telling banks that they have to remediate or transfer old LIBOR loans by June 30th. Okay, so that's what we're playing with right now. And really, this seminar is all about June 30th, to be honest with you. Who's in charge here? The New York Fed established the Alternative Reference Rates Committee. You're going to hear me call it the ARC. The ARC. It was made up of a body of smart people, public sector, private sector. And they've been in the background working on this paced transition plan that basically is trying to figure out what is the replacement and how are we going to replace it. So what is the replacement? All right. First, there's a bunch of bankers on the call here, so y'all know what I'm talking about, but a little bit of basics here. There is such a thing as a daily switching floating rate, like prime. Prime changes daily. LIBOR itself has a daily feature. You can have daily LIBOR. But the real attractiveness of LIBOR is that LIBOR comes in term increments, where you have 1 month, 3 month, 9 month, 12-month LIBOR. The most common in our marketplace would be 1 month LIBOR. It's effectively a forward lock. So basically, let's say you have, 3-month LIBOR. On the first day of that 3-month period, you're basically locking a rate prospectively into the future, and it'll be fixed for that 3-month period. And then it'll switch again at month 3. Forward-looking speculative rate switching on future increments of time. That's called, it's a term, it's a mini term, if you will, a short-term mini fix, but with a forward look. 1 month LIBOR, of course, being the market predominant. So the borrowers have the opportunity once a month, you switch. Okay. What are we going to switch to? Well, the ARC was pushing SOFR like crazy, and it was sort of a beauty contest. They wanted it because of its stability. You'll see that stability here in a minute. However, SOFR didn't have this term component at all. SOFR has always been a daily rate. So the girl they were taking to the prom wasn't ready yet. They were advocating a rate that was not apples to apples. Meanwhile, the derivatives and the capital markets is scrambling to invent it. And that's what's been going on in the background throughout COVID. For a time there, because of this unpredictability and uncertainty, there were some other suitors that popped up. Bisbee, the Bloomberg rate, which was Bloomberg invented it, was an attempt to try to create a surrogate. Ameribor was another option. I'm not going to go into why they failed, but effectively, SOFR has prevailed. Now, there has been, well, first let's look here. LIBOR, this is a little bit of a busy screen, but as I've explained, LIBOR lightly traded versus SOFR, which is heavily traded. So it's got some safety and soundness. What I didn't mention earlier is that LIBOR is, I did say that LIBOR is how much we would lend to each other overnight in an unsecured fashion based on the creditworthiness of the borrowers. Whereas SOFR is based on how much would we lend hypothetically to one another overnight, but if it was secured by US Treasuries, making it almost as a risk-free expression of cost of funds that you could find, and heavily traded. Now, there has been the development of one forward-looking term SOFR that emulates this forward-looking concept, and that's CME, the Chicago Mercantile Exchange. An outfit called the CME Group has developed this apples-to-apples comparison of a 1 month, 3 month, 6 month, 12-month term SOFR. And as you can see, if you look at this chart, this is from Friday, I think. So you got 1 month term SOFR at 4.56. If you compare that with present day 1 month LIBOR at 4.59, they're really close. And then you can also see overnight LIBOR, which is daily switching, 4.55, SOFR overnight 4.55. So they've gotten extremely, extremely close in this regard. Okay, that's what we are moving to. The question of how are we moving to it is now a matter of contract and legal documents. And in this regard, it's interesting that many sets of loan document forms promulgated by banks have paid so much attention to this that there's literally 2 sentences about it. Going back over the many years, it was just never envisioned that LIBOR would blow up. But here's an example from the common Laser Pro. If the index becomes generally unavailable, the lender may designate a substitute index and will provide notice. Okay, that's one glib way of doing it. The ARC promulgated this, and you can't read it because you don't need to, But what was really happening is that since 2019, and certainly during the pandemic, the ARC had been formulating a series of benchmark fallback provisions that banks could use to install effectively a waterfall of alternatives in the loan documents. So if term SOFR is available, we'll use term SOFR. If term SOFR is not available, we'll use this. If that's not available, we'll use that. Boom, boom, boom. And US regulators mandated that large national banks implement this type of language in new originations and in amendments as much as possible to basically set the stage for this shift. And the amount of work that was done quietly to establish these benchmark fallbacks is one of the reasons why this is something of a Y2K. Effectively, the way has been quietly paved, particularly with large institutions. Now, regional banks and community banks who don't have the huge volumes that the US regulators were concerned about are now also, even as we speak, trying to figure out how do we migrate from old documents to new documents. So that's what's been going on in the background. Okay. What happens now? And this slide really is the major takeaway. You know, what is going on now? What do I really need to know about this? And my first answer to that is focus on June 30 of 23. This is when LIBOR will really officially die. You've seen this phased transition plan that I've described. 12/31 of 21, banks had to stop new originations on it, right? They moved the goalposts. 6/30, banks need to remediate or deal with existing LIBOR loans, and LIBOR will no longer be officially reported from this date forward. Technically speaking, it's June 30th or sooner if the regulators decide that LIBOR has become unpredictable or unreliable sooner. Given the fact that it's March, most pundits don't believe that it will happen sooner. But in any event, that's the date to focus on. Okay, now, the other mitigant and the other reason why this has melted away as a little bit of a Y2K and the pressure, the Chicken Little concerns have melted away a little bit, is that in March of 2022, so March of last year, Congress promulgated the LIBOR Act, which does a whole variety of things. One of the things that it does is basically permit the automatic transition from documents that might not specify a fallback to a replacement that is endorsed by the ARC. And it creates a safe harbor for that. It creates a safe harbor for those within banks and lending institutions that are the, quote, determining parties who are establishing the fallback rate, and for those calculating parties who are the ones calculating the transition. And if you are following the ARC's recommendations and staying within those four corners of their suggestions, there's a safe harbor. And so this created a bit of relaxation. There was fear, tremendous fear, for a while that if we had to wholesale migrate trillions of dollars, that there would be a risk to lending institutions that the migration had occurred in a disparate or discriminatory way or whatever, that portions of the portfolio might be handled in one way and portions in another way. And there were a lot of fears about all of that, but this has created a great deal of relaxation. Interestingly, the CME term SOFR that I've described is the only forward-looking term SOFR that has been endorsed by the ARC for the time being. So CME SOFR is kind of where a lot of this attention is going to. I've heard tale that ICE, the Intercontinental Exchange, is working on a competitor to CME SOFR, but for right now, CME SOFR is the only show in town. There's another really important aspect to this that for the nerds in the audience like me, I really hope you focus on, and that is this. I've hammered in on this concept of LIBOR traditionally being a forward-looking lock. So it's basically a forward-looking prediction. And if we go back a couple slides, look at the way the rates work. The deeper you go into the future, the more expensive the term gets. Look at LIBOR 1 month, 3 months, 6 months, 1 year. It's speculative. So if a lender is locking a rate on day one of a 6-month period, it's going to be more expensive because the future is more uncertain, right? Okay, that makes totally intuitive sense. And 1 month term SOFR maps over to 1 month LIBOR very well in this regard. Don't be confused though. There's confusion about backward-looking averages. The New York Fed publishes SOFR also, but the New York Fed is not providing a product which is a forward-looking apples to apples equivalent. It's publishing something that is really apples to oranges. It's publishing a report on what SOFR has been looking backward over 30 days, 60 days, 90 days, or a year. So if you actually look at those trend lines, I checked it this morning, the Fed's numbers actually go down. Like if you're looking at a 6-month historical average of SOFR, it's way lower. I think it's even high 3s, okay? So what I mean to say is, don't just realize that CME SOFR and the Federal Reserve's historical average SOFR are two different calculations. So just realize that those are apples to apples to oranges. Okay, with all of that background, I think I've given you some reasons to appreciate the fact that this is a little bit like a Y2K. A lot of large institutions have already established remediation plans. There's a lot of SOFR-based debt out there already. And for community and regional banks who are still working on the migration as we speak, there's a bit of a safe harbor for how that migration works. Some banks are trying to figure out whether they're going to be doing this by unilateral notice to customers of how it's been changed. You might start to see that. Some banks are taking the position that they still need to do actual amendments where we mutually agree to how it's going to evolve and transition from one to the other. But again, by and large, many banks have already instituted this fallback waterfall that's automated. Okay. So what are some of the takeaways? Well, realize that the pin has been somewhat put back in the grenade. We're kind of watching the movie play. What does one do about this? Well, if you're not a banker, you might consider whether your or your clients' loans, intercompany debt, shareholder debt, contracts, operating agreements have LIBOR in it. Consider doing some amendments to it. I will mention as a little side note, LIBOR will continue to be published after 6:30, but it's generally deemed as being zombie LIBOR in the sense that it's so unregulated, so unreliable that it's sort of irresponsible to reference anymore. Another takeaway here is go with the flow with the lending institutions. So if you think about it, a large bank, even a regional bank or a community bank for that matter, if they're going to pull a big lever to change everybody's rates and terms on a given day, they must have a degree of uniformity across their contracts. So the notion that one could negotiate or create bespoke deals, or over the past several years, I've had many instances where borrowers or their lawyers have tried to negotiate the language of SOFR and You have to understand that there's not a whole lot of room for negotiation because you have to be able to pull that lever in one manner that has a consistent effect across the system. Bless you, Larry, even though you're on mute. So that's just, I think just have that degree of realism. I think those that rail against the transition, I wouldn't say naive, it's just that you're not appreciating the big picture. And it's not that this is something that lenders are doing to you, it's lenders responding to a realistic issue in the marketplace. If you have concerns or comfort about the way that the transition is happening, you can look online, and like I've shown you here, some examples of seeing how mathematically equivalent they are. I can say that there's been just a tremendous amount of energy put into trying to make this transition economically similar. And finally, an interesting and somewhat controversial topic is the fact that if you are an economist or an actuary, there is apparently truth to the fact that because of SOFR's stability, because of its predictability and soundness that LIBOR didn't exactly have, there is a published spread adjuster. I think it's 11.448% is the number actually, that was published by the Fed as, and that's for 1 month. That's 1 month. It goes higher for longer terms, but we mostly use 1 month. So in mapping it over, a lender has an economic right to keep it apples to apples, to boost. If you had LIBOR plus 2.5 previously, a mathematical equivalent would be 1 month term SOFR plus 2.61. Now, I will tell you, some banks are implementing that system-wide as a matter of policy. Some banks are not. This is an area of some variability in the marketplace, but just sort of be aware of it. In conclusion, and the slides will come out to you later, here are the links where you can access some of these different rates if you want to watch it play. And a quick word of warning is that, sometimes people call us and say, well, how should I draft my new rate? And the answer is, well, don't ask me. Ask the poor soul who's going to be calculating it, because whoever that poor soul is the person whose rate we need to draft. Okay. And pitfall to avoid, I think I've already covered this. Don't confuse 1 month CME SOFR forward looking with average look backs that the Fed publishes. Here are some nerdy resources that we can throw in the back here. And Larry, that's all I got for you today.
Great, Matt. We have one question, and I guess one takeaway that I absorbed during the presentation I want to point out. Pay attention to which SOFR benchmark your lending institution is offering, because obviously it could be a little bit different if it's, I don't know, Matt, I suppose nobody's offering the New York Fed, but it's CME or some other SOFR, that's going to create a little bit of difference between what you have with LIBOR and maybe what you would have.
That's true. Now remember, even 30-day average look back from the New York Fed isn't horribly different. I think right now it's 4.4 as opposed to 4.5. Okay, but it's not like it's radically off kilter. But when you start going out, very few of us really use 3, 6, 12-month LIBOR, frankly. So this is a bit of an esoteric, but the further you go out, the more different it becomes. I don't think it's fatal to use the New York Fed average look back. You certainly can if you want to. Just realize that they're two different things. The other thing I need to mention is that I'm not entirely clear about this, and I've asked the CME and I haven't gotten an answer back, but CME does require licenses to use CME SOFR. They certainly require licenses of financial institutions, although I've been hearing that there's some waiver of the licensing fee for a temporary period of time. I don't quite know, to be honest with you. I wouldn't have a whole lot of fear in referencing it without a license, but I'll let you all know if I find out whether what their answer. I've asked them the question, if somebody just uses it, if private parties use it for reference, surely they don't need a license, do they? I'll let you know what I find out about that. But just, I want to flag the licensing issue. If you have an option to choose SOFR or BSBY, is it fair to assume that BSBY will 10 or 12 basis points lower, but potentially more volatile? Well, it's interesting. BSBY was sort of made up by Bloomberg, and much like LIBOR, it doesn't have the soundness and trustworthiness of SOFR. So I don't know what in the marketplace people are charging, but the 10 to 12 bips lines up with this published discrepancy. It seems to make some degree of economic sense. I would say this, how they arrived at 11.448% is a careful dive into the future-looking mechanics of SOFR as compared with LIBOR. I bet you that if the same actuarial folks and economists look at the behavior of BSBY, which is a new product and relatively untested, versus the behavior of LIBOR, it wouldn't probably be 11.448%. It would be something different. I don't know what that is. But I will say this, BSBY is not, for a short minute there, BSBY was popping up with some frequency, but honestly, it really has not been as commonly used. So, what
Well,
else, Barry? Oh, we're over.
that's all I saw, and we're over time. Thank you so much, Matt. This was a great presentation, and thank you to all the folks that joined us. And we'll be in touch this afternoon with the presentation materials and a link to the webinar.
Thanks, folks. Thanks, Barry.